Today we are going to start with the leverage buyout sessions. Previously, we have completed the merger and acquisition advanced series along with discounted cash flows and valuations. If you are new to the channel, I will recommend you to go to the YouTube channel and revisit the previous episodes for a better understanding of this episode. So let's get started. So leverage buyout. A leverage buyout model is a financial model used to evaluate the acquisition of a company using a significant amount of borrowed funds. As the name leverage suggests, so the goal is to determine how much a financial sponsor, like a private equity firm, can pay for a target company while achieving a target return. And it's often measured as an IRR, internal rate of return. So the core idea here is that buying a company using debt plus equity. So we are actually financing it. We are leveraging it. That's debt component, and the other component which the shareholders have, which the shareholders are going to invest. That's equity. So using debt plus equity. So that's the main concept, the core idea of leverage buyout. And using a target company's future cash flow to repay the debt is what a leverage buyout does. So what I am doing is I am actually buying a company and I am using debt. I am raising debt. I am financing the money which I am going to use later on to purchase that company, to buy that company. That's my target. That the company which I'm acquiring is the target company. So what I will do after I have acquired the company, I will revamp the operations of the company. I will fix everything, but whatsoever I feel that's wrong with the company, then I will. What I'm going to do is I'll make the company profitable. I will change the management. I will change the way the things are working in the inside the organization. Once the organization is working up and running, then I will do what is that I will start to repay my debt using the target company's future cash flows. And eventually, after everything is good, I will sell out or take the company public at a higher valuation. So that's what a leverage buyout does. In assumptions are the input for the purchases, debt, and exit. Sources and uses are the financing breakdowns. Income statement projections are the financial projections which we were discussing about. Uh, Cash flow and debt schedule are here to track the payments, and return analysis is done by IRR and MOIC. So let's just do an example first so that let's do a easier, simpler example first. So I just wanted to show you. So, okay, let's assume that these are our assumptions. These are our transaction assumptions. So, do the first step one is about the inputs. So the purchase price is 500 millions. So we are going to purchase a company for 500 millions. Just give me a moment. 500 million we are going to purchase a company for. If the debt financing is 60%, this means that 60% of 500, if I simply multiply it with 60.6, that's going to be 300. And equity contribution is going to be the rest of the amount, the 500 minus 300, or the 40% of 500, which is 200. So that's the equity component. Here you can see EBITDA at entry is 50%, $50 million. We are assuming it. So this gives us EBITDA. So EBITDA is an important term. It would be used in debt to EBITDA ratio, debt slash EBITDA ratio, just for reference. And we are assuming that exit after 5 years at 8 times of EBITDA multiples. So today the EBITDA is 50, and after 8 years, Whatsoever would be the EBITDA, we will multiply it with 8. We will take the 8x of that EBITDA multiple of EBITDA at exit. Okay, so if 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 the company grows, if the EBITDA grows annually at a rate of 8%, so if the EBITDA grows at a rate of 8% annually, this means that the above 50 is going to compound itself at a rate of 1.0508 annually and for 5 years. So this is going to be our EBITDA multiple at exit after 5 years, $73.47 million. And don't get confused, all these amounts are in million of dollars. So the exit, the uh, exit valuation or the exit enterprise value of the company, what we are going to do is we are simply going to multiply the exit EBITDA multiplied by 8 because we discussed it here that the exit valuation would be 8x of the EBITDA at the exit, and this is the EBITDA at the exit. I hope this is clear. And debt payment, we have not created a debt schedule because this is a relatively simple example, and I just wanted to give you a taste of what you are going to understand in the next example. So I am assuming that the debt was $300 million, and we have paid at least $200 million in 5 years. So the debt at the end of year five is $100 million. So that's how much debt is left. So $100 million of debt is left. Okay, so if $100 million of debt is left, so how am I going to calculate the equity value? So equity value, it's a simple formula. The equity value at exit is the uh, exit valuation and the debt, the exit valuation and the remaining debt, exit valuation and the remaining debt. Write it down. Exit valuation, and we subtract the remainder of that payment. So this is our equity value at the exit. So if I have to calculate the multiple of invested capital, this is going to be simply my equity invested. We invested 200 millions of equity, and we at the end exit our equity valuation was 487.73. So how much, what is the multiple of the multiple of invested capital? So this is our capital, $200 million. We invested $200 million and we created 487.73 million dollars. So this is simply the ratio of exit value equity and the initial equity. So this is 2.43. So this is the multiple, the MOIC. This is the multiple. Let me just do it one more time. This divided by what we initially invested. So this is the multiple. And if I actually had to calculate the internal rate of return, how do I calculate the internal rate of return? That's also relatively very simple. So internal rate of return is actually an annualized rate of return. And the way we calculate it is by discounting it. Let me just show you. So we have, yes. So exit valuation, we are dividing by one by the initial invest in initial equity, and then we are going to subtract one, and this is going to give us 19 percentage of internal rate of return. It's a little confusing, and don't worry about it. Okay, so I hope this example has made sense. Now let's move to a bigger question where we have taken the debt schedule, we have actually taken the assumptions, better assumptions. We have taken the target financials of the company, target company's financials. We have taken the debt schedule. We have taken a summary of everything, where we have also calculated MOIC and IRR. So here, assume that the purchase price is 600 million. So 600 million is the purchase price of the company. We are assuming that the debt financing is going to be 65%. This means how this number is calculated. So this means 65% of this number is 39 390 million, and equity contribution is going to be 35%. So this means that equity contribution is going to be this multiplied by this equity percentage of equity contribution. Interest rate is 7%. And interest rate would depend on the debt component of the price. So we are going to simply multiply this with the interest rate. So interest rate is going to be 273 million, to $27.3 million. Okay. And annual debt amortization. So this much is the debt and amortization. So every year, this much amount will be paid back by the company. So $39 million. So this is a $390 million and $390 million loan. And every year, if they are going to pay a debt of $39 million, so this is a 10-year loan. Revenue growth. We are assuming that the revenue of the target company is going to grow at a rate of 7%, and EBITDA margins are 20%. Exit multiple. So exit multiple is 9x, and the tax rate is the 25 percentage. So taking these parameters into consideration, let's go to the target financials. So target financials, these are the number given to us, and these are the target financials, and we are actually forecasting these numbers. So how does it happens? So we were given that the revenue every year grows at a percent seven at a rate of 7%. So I have done what? I have multiplied the previous year's revenue. I have multiplied it with previous year's revenue. I have multiplied it with 1 plus the rate of revenue growth. I have freezed it using F4 uh, so that it doesn't drag here and there. These are the numbers. These numbers actually match. We can put a sum check here also, so that if there is any difference, it just reflects here. EBITDA is going to be 20% of revenue. So EBITDA is going to be multiplied by 20% of the revenue. I have selected revenue. I am going to freeze this column one more time by clicking F4. So see the difference. I want the whole column to freeze. I want the row to freeze. I want the column to freeze. So I have put a dollar sign in front of the column also and the row also. B8. There's a dollar sign in front of both. If I want only to, okay, we will discuss it later on. So this is giving us these values. I can sum check it out and see, is there any difference? No, there is no difference. Okay. All right. So after EBITDA and EBIT. After EBITDA, we have EBIT, and we are assuming that depreciation is at a rate of 5%. Here I have not given it. Depre Dep is at a rate of 5%. So debt is at a rate of 5% of revenue. No, of EBITDA. Debt is at a rate of 5% of EBITDA. Depreciation at EBITDA is 5%. So if I multiply depreciation rate, I multiply F 0.05. So I get these numbers. And then to get my EBIT, I will subtract the EBITDA numbers from the EBIT. I will subtract the EBITDA numbers from, I will subtract the depreciation for EBITDA numbers. And this way I will get my EBIT. And let's check if all my EBIT numbers are right. No error in the sum check, no difference in the sum check. Now let's discuss about interest expense. We cannot forecast the interest expense unless we forecast the debt schedule. And okay, we will discuss about interest, but if you remember how does the uh, income statement works, this is the pre-tax income, which is not calculated as of now. We need to calculate this. So pre-tax income is going to be EBIT minus interest expense. That's our pre-tax income. I hope you remember everything what we discussed in previous episodes. And income tax is going to be 25% of the pre-tax income. So I'm going to multiply it by 0.25. This is going to give me my pre-tax income. Let's just put a sum check here. I hope you guys are able to follow what we are discussing. Okay, let me just give me. So this is pretty much easier part. So this means if my income tax expense is this much and this is my pre-tax income, what I'm going to do is my pre-tax income and I'm going to subtract my taxes. So these are the numbers of the net income. These are the net income numbers and I am going to subtract to see if there any difference. So these are my net income numbers. Okay. So I hope at, at least this part is clear, the income statement part. I hope this you guys have understood. We have not discussed how we calculated the interest expense as of now. And as of now, we have also not calculated the free cash flows. We will do it after we will understand the interest expense. So for interest expense, so interest is a component of debt. Interest is paid on debt actually. So debt financing generates the interest expense because of debt financing. Because we have debt in the schedule, we have bought a company by 65% of debt. So whosoever has given us the debt, we actually have to give them back the principal along with the uh, interest on the principal. So for this, we actually have a debt schedule. So for the year one, which is the initial frame, and this is the forecasted frame. Where is the assumption? Okay. So 65% of the debt. So this is $390 million. So our debt starts from $390 million. The interest rate is 7% and annual amortization is this. So we will be needing these three amounts here. Just focus on for a moment. You will understand everything. Debt schedule. Let's go to debt schedule. So $390 million, $390 million we have raised. And the interest component is 7%, 273. And the annual amortization, the debt amortization is 390. So this is 390. Let me just give me a moment. Just give me a moment. Let me just try to fix this. Okay, now it's much better to understand because of the decimal in the commas. So this is $390 million. This is $39 million is the debt repayment, and interest component is $27 million, $27.3 million. So let's calculate how the debt schedule is made. Okay. So the initial this closing balance, the closing balance for the previous year is going to be the opening balance for the previous year. And this is pretty much everywhere in the model. These are the numbers which we are calculating. Now let's understand. Let's just start from here. So this interest expense is calculated on the basis of the next year's interest expense, next year's opening cash on opening debt. If I multiply this with F4, so this is calculating the interest expense perfectly. And here, because the opening balance, we do not have any opening balance in future. So let me just do one thing. So I'll let me just assume that uh, let me just take the closing balance because that's going to be our opening balance for the next quarter. Let me just change it to I3 so that it also gets calculated. Okay, so this is be getting calculated. Principal repayment. The principal repayment we have calculated. This is what the principal repayment is, 10% of the open debt. So principal repayment is 10% of the opening debt, and I'm going to multiply the debt amount by, I'm assuming the assumption as F4. I'm going to assume this thing. The assumption, as per the assumption, the formula is this much. Okay, this pretty much this. So there is no difference in the formula also. So I hope this is little tricky, but I hope you have and you are understanding this thing. So once we will do the question answers, and after when we will do a proper LBO model along with the DCF and the relative valuation model. So now, since we have calculated the interest expenses, now let's plug those numbers back here. So interest expenses are going to be, I am going to take it from the debt schedule. So debt schedule, we have calculated these numbers, and I actually have to divide it through million of dollars, $1 million. And this will give me this number. So these are the numbers of interest expenses. At times when you're going through numbers, it's little confusing and tricky, but after a while of practice, you will understand how these numbers are, how to work through Excel different sheets. Now let's calculate the cash flow. So previously, or okay, you we discussed about the cash flow. So cash flow is calculated as the net income. We add back the depreciation, the non-cash charges, and then we subtract the uh, principal repayment component or any changes in fixed asset. This is our cash flow. When I convert these two numbers, these get fixed. And what is the whole purpose of doing this exercise? So this is the introductory session for leverage buyout question and answers. And this will be helpful when we will do the leverage buyout question and answers. Okay, so afterwards, the summary. Previously, we have discussed about the IRR and MOIC. Now we are going to calculate the sum, IRR and MOIC for this company. So exit enterprise value. Exit enterprise value, if you remember, exit enterprise value is going to be the 9x of the exit EBITDA. And the exit EBITDA here is EBITDA at the year of 7 is 90.04. So this is going to be this multiplied by 9 times. So 810.39. So this is going to be our 810.39, the exit enterprise value. And how is the exit equity value calculated? So equity value is calculated by simply we are going to subtract any debt repayment which is still not paid. So the closing balance of the last year we will divide it by 1 million. 603.124 million dollars is the exit equity value. MOIC, multiple of invested capital, need to divide it by the equity, the exit equity. So I'm going to assume we are calculating. This is a metric to calculate the equity value, not the enterprise value, 2.87. And this is actually a number. This is actually a number. And the internal rate of return. The internal rate of return is calculated by uh, internal rate of return is still the same thing, equity value. We are going to divide the equity value. We are going to divide it by the assumption, this value, the initial equity value of the investors. We are going to root it by 7, and then we are going to subtract 1. And this is actually a number. So this is how we see a leverage buyout. So when after profit, this profitability here, let's discuss profitability here. If you look at the target financials, so after 1 year, we start to generate positive cash flow. So this is the summary page where they are saying the profitability year is year one, after 1 year. And this is the multiple. So multiple on invested capital is 2.87 and internal rate of return is 0.06. So these assumptions were based on, so these calculations are based on these numbers, and these numbers were driven by what? These numbers are driven by these numbers. Revenue growth of 7% and an exit multiple of 9% at a rate of tax rate of 10% of 25%, debt at depreciation at the rate of 5% of EBITDA, and interest rate of 7%. So always remember this thing, that forecasting revenue at a rate of 7%, interest rate at a rate of 7%. If interest rate is at a rate of 7%, this means this is very low interest rate, because even if you go to low bank for personal loans, they don't give you even 7% of the interest rate. Even bank FD is giving you less than this percent of interest rate. So this is was a hypothetical question. If I were to increase the interest rate from 15%, I mean to 15%, so this is going to change my valuation. I have not linked everything. So this would have changed my valuation considerably.